Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
If you want less of something, tax it. If you want less of everything, tax everything. Subsidies are how inefficiency earns respectability. Most convictions are strongest before they are tested. We admire discipline in others and exceptions for ourselves. Courage is rare, justification is abundant.
FY26's leaderboard has a plotline markets did not expect. PSUs and old economy names stealing the show. SBI tops wealth creation with Adani Power and Reliance close behind. Banks and energy said value matters again. Meanwhile, IT took a hit. TCS, Infosys, Wipro all saw serious erosion. AI hype met margin pressure, and suddenly the growth premium looked negotiable. This is a classic rotation from expensive certainty to cheaper cyclicals with earnings visibility. What a year! Equities down, rupee down, FPI is out, but oil and gold absolutely on fire. This wasn't a market correction, it was a macro collision. War pushed crude up 40%, gold surged 45%, and volatility doubled. Meanwhile, foreign money exited like it saw the bill coming. The only cushion, domestic investors, quietly absorbing nearly 8.5 lakh crores. Without them, this would have looked a lot more uglier. So the bottom line is FY26 wasn't about fundamentals, it was about survival in a geopolitical storm. Earnings expectations aren't collapsing, but they have clearly downshifted. FY27 and FY28 estimates are flat to mildly negative month on month, while FY26 has already seen a steady grind lower. So the key signal, the earnings revision ratio is slipping below long-term averages, meaning more downgrades than upgrades. Not panic territory, but definitely not bullish either. Why it matters? At current valuations, markets need earnings upgrades to move higher. But right now the cycle is wobbling, thanks to oil shocks, global uncertainty and slowing growth. Only 2 states under the debt limit, and that's less exception and more endangered species. Most are hovering well above comfort levels, with some flirting with 40 to 45% debt to GSDP, which is gross state domestic product. This isn't just accounting, it's a growth trade-off. Higher debt means higher interest costs, less room for capex, and more dependence on central support. The irony, states are driving India's growth push while quietly stretching their own balance sheets. After years of being expensive but justified, Nifty is now just about fair. Trading near long-term average price to earnings, not screaming cheap but no longer stretching logic either. Earnings growth is steady, not spectacular, so multiples have quietly normalized instead of collapsing. This is what a soft landing looks like, valuations cooling without panic. For investors, this is the uncomfortable sweet spot. Not exciting enough to chase, not cheap enough to ignore. For years, India traded like the VIP section of emerging markets, and now it's moved a few rows back. The valuation premium has cooled sharply. Against the S&P 500, India is no longer pricey, it's flirting with a discount. But versus emerging markets, the premium still holds, just less comfortably. And here's the nuance. This isn't India getting dramatically cheaper, its peers looking weaker. Relative math, not absolute magic. Investors aren't abandoning India, they're just no longer willing to overpay for the story.